Good afternoon, everyone, and welcome to this webinar this afternoon on what's the best response to MiFID II. This is Julie Patterson from KPMG, and I'm joined by Bernard Hébrin from Invesco, JB Beckett from the Association of Professional Fund Investors, and Richard Garland from Investec. I thought we just might start by obviously saying that MiFID II, just looking at the first slide that you can see there, MiFID II is a very large and wide-ranging law. It's got hundreds more pages at what's called Level 2, or technical standards, and even more hundreds of pages at what's called Level 3, which is guidelines and FAQs, frequently asked questions. So this is very, very wide. What we're going to do just for this short webinar this afternoon is focus on a couple of areas, really. One is the impact on investment funds, their distributions, but then also look at the what distributors will need and what investors will receive, and have some discussion around that. But perhaps just by way of opening up, I suppose the other thing we should say, and perhaps we could move on to slide 2, is that MiFID isn't alone in this. MiFID is very big, but there's a number of parts of MiFID that touch on issues that are covered by other pieces of European regulation and guidelines. And that the slide you have in front of you now gives a very brief sort of summary of some of those. So over the course of this year, there's quite a lot, really, for the industry to do. And perhaps that just take me to the very first question. And perhaps, Ben, I could just start with you. How are firms managing to handle so many regulatory changes at the same time?
This is a topic that is, the answer to that question can be, we can start with reminding that it's a law, a European directive at the beginning. So in many firms, in many groups, it started with the legal teams. And depending on the group, in some cases, the legal people kept that new regulation or that set of regulation for themselves for quite a while. And depending on the structure of the group of the asset management firms, the people, the different other functions realized that they were heavily impacted sooner or later. So, in a nutshell, I would say that as the deadlines are coming closer by now, all of this MiFID project in the most asset management groups turns out to be very good news for lots of consulting firms and service providers of all sorts, as it looks like many things would be outsourced. But more and more, all of the functions across the industry are realizing they will be heavily impacted by those new sets of regulation. So how well are firms prepared? I would say better and better, but according to here and read from the industry, it looks like a whole lot of work still remains to be done.
Thank you, Bernard, for those thoughts. And Richard, did you want to add something there in terms of what you're seeing with all these raft of changes?
Well, first of all, just as this webinar was getting going, I received an invitation to the Investec MiFID II product marketing and distribution workstream, which we're now having on a monthly basis. So to take Bernard's point, what's happened is it's not just compliance and legal, it's very much impacting marketing and distribution. And on top of that, it's not just about MiFID, it's about AFMD, it's about PRIPS, this is a huge amount of work for asset managers, and there are a huge amount of costs involved now in meeting all these new regulations and trying to make sure you're on top of them. So actually, the question I could ask is, who bears these costs? Because the costs have to be paid by the funds, and that impacts the end investor. So we are all, as an industry, being slightly overwhelmed by all these new regulations. And one hopes that at the end of the day, they actually benefit the end investor.
Perhaps that's an interesting point, Richard. Thanks to bring JB in professional fund investor side and fund selector side. Do you have a general view or take, JB, on what you're seeing in terms of firms' general readiness for this whole swathe of new regulation?
Yeah, it's a good question. And firstly, good afternoon, everyone. I guess from an APFI and a fund buyer's view, I think the first probably frustration for us as fund buyers has been the protracted nature of the MiFID II guidance coming through from ESMA, especially with regards to the Level 2 guidance. And I think that's created a lot of uncertainty for professional fund buyers, both in terms of reconciling the UCITS legislation with AIFMD and PRIPS, but also the fact that it's a double whammy piece of legislation because it also introduces MiFIR. And MiFIR really hits professional fund buyers in our understanding of the use of alternative and OTC instruments in the fund market. So fund buyers are actually having to try and kind of balance that. At the same time, how they then will have to be expected to communicate both risk and cost to the end customers. And then lastly, again, that interaction with the fund managers of both cost disclosure, the use of OTC, research and reporting, which of course just amplifies and increases the amount of due diligence work that we have to do.
In all, a very significant body of work, and I suppose that's sort of the general view. But even just looking specifically at the distribution side, which we can come on to, and the slide we've got in front of us now just is a very brief summary, just in the area of distribution. Some of the areas of MiFID II that will impact the distribution chain, and I suppose that probably takes us really to our kind of what we might say is our key question. Maybe for you this afternoon, Richard, perhaps first. What do you think will be the likely impact of MiFID II on the fund distribution landscape?
Well, the problem is it's not going to be a uniform change. Each country is going to adopt different approaches to MiFID II. And I just came back from Switzerland, obviously meeting large distributors there. And most distributors, as I see it, are going to go down the non-independent route, which means they are multi-tied, and that means they can still take inducements or rebates. So, and then certain countries like Italy are going to bluntly maintain taking rebates. So this idea that MiFID II equals no inducements, like, say, RDR, is not true. And I think people don't really understand what MiFID II means. But the one thing I can state very clearly is that it is part of a longer-term trend, which is not, it's a structural change, which is not going to stop. And RDR may be an extreme version of that, but you're seeing it also in the US with the Department of Labor ruling. And eventually, we're moving into a world where rebates have to go away and where clients are charged a wrap fee. And now in that world, costs become more important. And I think one of the very big positives of MiFID II is transparency and the focus on costs. And that's a good thing. And I think that's what's missing from our industry. So the bigger trend I see is this, inevitable move towards rebates eventually disappearing, which is good for our industry and good for the end client. And then, transparency. But the final point I'd make, though, is it also leads probably to, and JB may disagree with me, the potential death of open architecture. And what we ended up globally is with guided architecture. But by definition, if you are non-independent and you're multi-tied, as a distributor, you can't be multi-tied to 50 fund management firms. You're going to want to work with 20 or 25 firms at most, and probably even less. So I think we're going to see a concentration of funds on the buy lists at the fund buyers. So it's going to be the winner takes all, and guided architecture will prevail.
Thank you, Richard. There's a lot of points there. Maybe we can come back to one or two of them in a moment. Just to say, I've just come to you, Bernard, next, but just to say, there's a few questions here just asking if the slides will be available. Very happy to make those available, Lucy and Andrew, so just answer that quick question. The other one, a point was made that there's some feedback. I've just changed my handset slightly, so let me know if that's helped at all. But we'll come back to some of the other questions. But could we just, Bernard, come back to you first on just your overall take on the likely impact of MiFID II on the fund distribution landscape?
As in many situations, we have here a pan-European regulation, which might end up being applied in different ways depending on the country. Obviously, we've just mentioned the Swiss banking networks or some other countries, and maybe the Italian situation has some similarities with that. But it's not impossible that we end up with a series of countries where the non-independent advice becomes the most common way to distribute funds. It's one possibility, and it's likely that it was not the initial aim of the regulation. It wouldn't be the first time that a regulation ends up with an opposite outcome to its initial outcome. But second, is the RDR the end game of it all? It looks like we have in different countries, obviously industrial lobbies, but also some regulators opposing the ban on rebates. We have that in some countries, so it's not quite clear to us right now if an RDR-like universe in a number of years from now is the end game. So for the moment, what we have to do as providers is to adapt our range with, for instance, a series of share classes that can be the best fit for this and that kind of distribution network or this and that country a legal framework. And maybe a last point on one possible consequence of the implementation of MiFID in some countries is that there could be a growing need for sub-advised portfolios instead of like usual or open architecture. So that could be an outcome we could see in some places depending on how the regulation is applied and implemented.
So I just want to come in on that, because that was absolutely my view. Bernard and I had a chat about this, obviously preparing for this webinar. And it was interesting after my meetings yesterday is that one of the challenges of doing the sub-advised route is that the brand on the fund would be, XYZ Bank or whatever. I'm not going to name a bank. And there's this whole challenge about using in-house funds and whether the end client, the actual client, the high net worth individual client, wants to have in-house products. So while sub-advised is a perfect way for distributors to protect margins, it may run into the problem of being seen as more of a selling in-house funds, which is not in many cases ideal. So I thought that was just an interesting bit of feedback I got from my meetings yesterday.
So I think what you're both saying really, isn't it, that actually the impact isn't not a straightforward one. It's different in different markets. It's different depending on the actual end investor type. It's different depending on the distributor type. So it's a sort of a multi-dimensional question with a very multi-dimensional answer maybe as to the impact. But the JB, having heard both what Richard and Bernard have to say there, it'd be interesting to hear your thoughts on what you see happening already maybe, or what you think might happen going forward.
Well, I mean, obviously the simple answer here, I think from a fund buyer perspective, is that we're going to be put under increasing pressure in the selection of active and alternative funds for our customers. If I could pick up, though, on a couple of points that Mr. Garland mentioned. The first one he made a reference to the RDR and both the retail and the institutional market. So we've already seen from the FCA in their interim report for the thematic market study into the asset management sector that they believe that the investment consultants need to become more fiduciary and are going to be put under increasing scrutiny, I think, in both the advice they give to defined contribution pension schemes and scheme trustees and the costs and the fees that they're negotiating. But if I just pick up on one point you mentioned there about the Department of Labor fiduciary rule that's happening in the US, we do have to step back for a second and recognize that that is the result of a Democratic administration. And Trump has already named Andy Puster as
JB.
head of...
Okay, I need to just make one point, sorry to interrupt, but it's got nothing to do with politics. Obviously, yes, that was a Democratic party that put that ruling in, or obviously drove it. But I spend my life in the US speaking to distributors, they're going to do it whatever happens. Maybe they don't end up with the fiduciary standard, but they want to reduce dramatically the number of funds they work with. So Merrill Lynch, for example, is taking a third of their funds that they currently distribute off their platform. UBS is doing the same, so is Wells Fargo, so is Morgan Stanley. So this train has left the station. The fiduciary standard may not be imposed, but offering less funds and working with less managers, that train's left the station.
I'll go further, Richard. Basically, Trump putting Andy Puster in is on the same sort of level as Trump putting Scott Pruitt into the Environment Protection Agency. So I agree the market forces, but the Democrats definitely had a policy of more customer protection. I think Trump's already shown his hand that he's actually going to make life for the U.S. investment banks and asset managers much easier. I think we may see the gradual revoke of things like Glass-Steagall and Volcker rule. I think we're going to see a different trend coming out of the United States. The risk there, I think, particularly to the UK, is that we end up having basically gold-plated ourselves in terms of from a fiduciary and a retail distribution review. That's my worry, just picking up on the earlier comments made about Italy and Switzerland, for example. So whilst I think the direction, which is, by the way, in the UK, very politically supported, one of more transparency and cost transparency, etc., I think it is going to be interesting as to how the US deals with that going forward at a time when we're obviously seeing more kind of local nationalist approaches to this in Europe as well. So I think that's one thing. The other point I'll just quickly pick up on something you said, Richard, was that this general trend would actually be would lower costs for customers. Well, obviously, given the proposals that we're seeing, optically all fees will look and appear higher right across the board. But the point on rebates, we should remind ourselves that large institutional investors do actually enjoy quite significant rebates. You and I have argued on this point before. I'm still resolute in my view on it, seeing it from the fund buyer's perspective. And the reality is, in passing back so almost towards the common good, this kind of idea of fairness and transparency to everyone, that the customers of large institutional platforms may actually end up paying more in the new world. So there's a couple of points there I would make.
Okay, so I need to come in quickly on that because I think the challenge is where do the costs reside? Because as fund managers, our costs need to come down. And I think the market pressures will pull the cost of active management down. We've still got the threat, obviously, of ETFs and passive funds. But, you know, that is an interesting point. When you add all the costs from the platform with the wrap fee, does the end investor actually end up with a lower price? And that is an interesting dilemma with all this. So, but ideally, yes, ideally they should. But what's amazing is, and I will never mention any names, but when I talk to distributors about the fees they charge for wrap fee, for advice programs, they range from 30 basis points up to 120. So 1.2%, which is just on top of, obviously, the fees in the funds, so which is mad. So that's going to have to see market forces bring those pricing down, and that will happen, or has to happen, rather.
Well, that's a very interesting exchange. Thank you for that. But I mean, Bernard, perhaps I could bring you in again in the conversation here with perhaps a slightly different angle again, because we're also seeing quite a growth in the ETF market. Now, maybe that would have happened anyway, but do you think there's any link here? And whether or not there's a link, will this also, just the general growth of ETF, will this have an impact as well on the distribution landscape for the other funds, for the actively managed?
So obviously, as a follow-up to the previous exchanges, obviously we're seeing big pressures on margin in the asset management industry. ETFs are part of that. The growing size of the ETF markets and the growing portion of ETFs in the client portfolio has something to do with that pressure on margins. But still, at the end of the day, if we consider that some kind of margin has to be made by the distribution networks as well, and ETFs by themselves as standalone investment products are in many cases not an appropriate tool, not an appropriate investment vehicle for the end investor. It's likely some kind of wrapper around the ETF is needed by the end clients and or by the distribution networks. It can be some kind of mandate which relies on ETFs to implement the asset allocation, or it can be some kind of fund of ETFs. There can be a number of different structures in which ETFs, which are in high demand, are used. But then this structure can be the place where the margin for whether the distribution network or the asset manager, or hopefully in the best of worlds, both can be made. And it looks like the RDR has given some kind of growth to that kind of structure, at least in the UK.
Yeah, thank you for that, Ben. I think you're quite right there. But I wonder if we could use that as a flow into maybe the costs and charges side more explicitly. Just to say thank you for those who are sending in questions. Just to note that we have had a question, what impact will Brexit have on implementation of MiFID II? That's a very interesting question. I fear in the time we've got left we're not going to be able to answer that, but maybe I could leave that with the webinar organisers. That might be an interesting one to take. In fact, generally Brexit having an impact on the distribution of funds cross-border around Europe and between the UK and continental Europe would be an interesting discussion. So thank you for that question, but I don't think we've got quite time for it.
Julie, we can answer that very quickly, because if you look what's happening, I mean, if you've got Luxembourg funds, the question is, do you have enough substance in your operation in Luxembourg to be deemed to have, a fund range that can be sold across Europe? And I'm sure Bernard's looking at this. We're looking at it.
Well, so yeah, but I don't think that's quick a question answer, Richard, because you've also got to think of what happens to UK funds that are UCITS. They'll no longer be UCITS. Do you see what I mean? I think what I'm meaning is there's a lot of strands in that question, which I do think.
No, but all I would say is that yes, OICs in the UK become just a UK product.
They become alternative investment funds. They come under the AIFMD.
Yes.
So so there's a
whole. We're opening up a can of worms, Anna. Sorry.
Yeah.
Yes.
Okay.
You're
So
right.
I'm going to cut you, Richard, there, please, because the key part of the other thing we wanted to talk about in around a few minutes is a bit more about this communications with investors, because there's all this stuff, extra disclosures coming on costs and charges and target market. And actually, in fact, we've got some questions there. One is, first of all, on inducements, actually. Let me just finish that off. There was a question, do we regard rebates paid by fund managers to distributors as inducements? Well, I suppose, to be honest, whether or not we think they should be, MiFID II says that they are. So I don't think we can get around that very well.
Julie, as Bernard said, the key is we offer all the share classes that the distributor needs. If they choose a share class with a rebate, that's their choice. We would be fine. We'd be happy offering super clean share classes with low management fees, and that's where the industry should go. But if they choose to use a share class with a rebate, that is their choice. Not something we push.
Yeah. Can I offer a fund buyer's point on this, because this is very topical. So right now in the day job, I've been in the process of turnover of about 60 funds, 20 new funds coming in, 40 new funds going out. The issue of rebate comes up time and time again. And I guess what I've said to fund managers when I've been dealing with them is saying, okay, we know where MiFID II is, and we expect that at some point we'll be reversed into a MiFID II situation through a clean share class. But in the meantime, what is the best deal on the table for the customer? That is the first and foremost guiding rule. Can I just pick up on that issue of rebates? I know of no large UK institutional or insurer that does not fully pass the rebate on to the end customer. So let's just quickly get that out of the way. The reason it's not necessarily seen in the TER, quoted TER in the mainstream, in the public domain, is because the rebate is applied after the net asset value of the fund is struck and the share class is struck. And it's actually added through unit creation, not through adjusting the price. Now, that is because there was a 20-year history between large insurers and distributors and fund managers that came to the agreement that if the insurers and distributors helped support the asset managers, for example, in the primary retail class, that they would then enjoy rebates. Now, the reality is, obviously, the industry is moving beyond us. We are now moving towards a transparency. I am under no illusions that once we get to what that final outcome looks like, and I can no longer use rebates to get the best deal for my customers, that I'm probably going to end up paying more for those customers to access the same funds. That, unfortunately, is free market competition, because unsurprisingly, asset managers don't want to be able to show everybody what the cheapest share class is available for that fund. So that is just a reality. And I think, okay, we're heading in a direction, but let's not try and say that rebates is about inducements or bribery, etc.
JB, can I ask you to continue actually and just expand that point into the extra disclosures you're going to have now on the costs and charges? Because in one sense, whether or not there's any rebate paid, the MiFID II requirements are going to require the distributors to aggregate all the stuff that's been paid out down the distribution chain and present that to the investors, to their clients. That's one thing. So that was sort of one of the questions. And the other area of disclosure is this new thing in MiFID II on target market. How on earth do you decide what the target market is for, let's say, a European equities fund? A very straightforward one that's got no structuring in it of any sort. And in fact, that was one of the questions we've had coming in is, how will the distributors and the fund selectors, what will they do with this information that's got to come to them on target market and on these cost of disclosures? Do you want to take that initially in terms of how you will deal with that with your clients?
Yeah, I mean, first and foremost, you mentioned a point there about, well, what does it mean if we're moving to a sort of fully disclosed cost regime? Well, the reality is it will, as you say, be passed to customers. That will create some sort of industry forces within the industry that will probably lead to the changes on fund pricing. Absolutely, that's going to happen. And as an ambassador for the Transparency Task Force, I fully embrace transparency. I do believe it's the most democratic and a good starting point. I think it's just my earlier point was just a recognition as to where the industry has been, and you can't just kind of flick a switch and hope for always for good outcomes. I think there's a transition period that's going to happen. On your second point, the amount of information that comes into professional fund investors has been accelerating rapidly, well before MiFID II. And, I would say there's probably an 80-20 rule. So there's probably 80% of the information is retained by the professional fund investor as part of our ongoing fund governance and selection. And then only 20% is probably passed through to the end customer because it is in a regulated fashion. I think the question for ESMA and for local regulators is, do we want to kind of follow the same direction as the SEC did in the mid-2000s, which was you'd have actually fairly relatively basic information on say, a front page piece of marketing literature and 4 or 5 pages worth of caveats. And I think we have to be careful that almost in our rush to try and supply customers with more information, we actually end up bamboozling them with information. I think actually the moving towards a fairer, more transparent price regime and disclosure regime in itself doesn't mean we have to therefore supply everything to the end customer. So when we're targeting, I think that is something that still needs to be worked out. I don't think either asset managers or fund distributors are kind of fully ahead of that, mainly because we've probably found the signals from the regulators a little bit inconsistent.
Okay. Thank you, JB. I mean, maybe just taking that point and moving to Bernard, but also picking up one of the questions here, which is really actually, you've got all this transparency. So Bernard, in terms of MiFID II, basically says you've got to produce all this stuff for funds, costs and charges and target market. And in some countries, as fund managers, you'll have to get back information from distributors. So you've got a lot of data going to and fro here. And we've also connected with all that. You've got all these extra costs for you, and you've got this pressure on fees. There's a question wondering whether the fund industry will focus more on alpha in order to reduce the impact of the reduction on fees. Sorry, that's quite a big area. But Bernard, do you want to just make any comments generally about communications with investors and all this information, and also this question of pressure on fees?
Yeah, then again, on this communication topic, what we can see is that starting from the very common European regulation, we could end up with a very fragmented set of literature going out to different national markets, depending of some kind of gold plating by national regulators, and plus different target markets by themselves, and just defining them could be tricky in some places. And obviously, what you've mentioned about the pressure on costs and on margins. On the other side, obviously, all of this is adding a lot of cost on the IT and data management sides of our businesses. Whether we outsource that or we keep it in-house, it anyway has a big cost. Margins are under pressure anyway, that's for sure. So obviously, the fund houses that can afford it or that want to go down that road will use whether the pure alpha generation like business, which is a tricky one because it's obviously not for sure that you can generate alpha, and you have other firms, or maybe the same ones in some cases, that will go for the size, and maybe having a handful of bigger and bigger asset management firms on one hand, and some boutiques can be one outcome, but some kind of premium to the big fund houses seems to be given once more by that new set of MiFID regulation. That's what we can see right now.
Thank you, Bernard. Just to the organisers of the webinar, we're getting quite a lot of questions, so if it's okay to continue, I appreciate we're just over the half hour. Maybe if we could continue just for about 5 minutes. We won't be able. Thank you for all your questions. We won't be able to pick them all up, but I would suggest that we carry them forward, and where we can, perhaps they could influence the topic of the next webinar. But Richard, I let you come in there. Do you want to make any general comments about this whole area of this raft of information that you have to prepare now that ends up with investors and what you get back?
Well, it goes back to the point JB made, is we send out way too much information. We have regulators demanding we send more information. And is it actually for the benefit of the end investor? I don't really believe it is. And, you know, the volume is a nightmare just for us to produce, but also for the end investor to read. So it's regulation gone mad. And I think we need to simplify everything. And you know, the problem with regulations, and this is the difference with the US. If you put DOL to one side, the market in the US had moved towards wrap fee. I mean, fees in the US are much lower than they are in Europe or elsewhere, and that was market forces. That wasn't regulation. Once regulation gets involved, it overcomplicates everything. Now, maybe you can make the case that the industry needed a push. But now the industry needs to let market forces drive it, and we need to simplify our industry. We need to bring costs down, and we need regulation that doesn't overcomplicate it. So I do believe that MiFID II has some good elements to it, and I do think that from the asset management perspective, we want to offer the best pricing to distributors, and we want clients to know what they're paying for that product. And overall costs must come down for the end investor. So that's why MiFID II gives us a push in the right direction, but really market forces need to take us there. And eventually we're going to end up with a Napster moment. And unless we adapt and change, we're going to be taken out by a Google or Amazon or whatever. So we've really got to get this industry sorted out, and it's not going to be driven by regulation.
Thank you, Richard. And just to say, I think that's a very interesting point, maybe to end on there. I'm just conscious of the time, but just for those who put in questions, just so everyone knows, first of all, I'll repeat again that some people have asked for slides. That's certainly available. Also, the audio recording of this will be available, so all that will be there. Thank you for those questions. As well as the question on Brexit, which is quite a big one, just so you know, there's also been a very interesting question on MiFID II and the impact on Asia. So maybe the whole question around, the way these things move around the globe and affect the globe now, how the US regulation affects non-US fund managers and how European regulation could affect the Asian market. I think that's a very interesting topic with an awful lot in it, so probably one we can't take now. But perhaps in fairness, so many people have bothered to put in questions. I think perhaps an interesting question to end on, even if we can't really answer it, is the question is how will regulators in the industry convince the Commission to change their stubborn position on past performance and scenarios? And I think you could say the same thing on transaction cost methodology. We will have to give investors more and more information, and the figures will look pretty odd in many cases. How you can change that, to be honest, I don't know. I do know that the industry at large, many of the players are trying very hard to bring the investor voice here, but maybe that's something, JB, I don't know, if something that APFI might want to think about more, really getting the investor voice into these debates about what they need and want, but most especially what they don't want. That would be quite interesting. But I'm conscious now of the time, so I think we probably ought to call it to a halt, but thank you very much, Bernard, JB and Richard, and a thank you to all those who participated for your very active questions. And we will speak with the webinar arrangers to try and see if we can do some follow-ups or possibilities on various the topics you've raised here, which are very wide-ranging. Thank you all for your participation and comments, and we look forward to your participation in the next webinar. Good afternoon.
Thank you. Bye.
Thank you. Bye.